Ralph Cram. Welcome to Net Lease TV. Ralph is with Envoy Net Lease, and we're going to be interviewing Ralph about preferred equity, construction financing. It's Tuesday, March 15th, 2022. Hey, one good thing, price of oil is coming down. We're going to save money at the pump. Price of crude is down to $99 a barrel. It was as high as $125 on March 8th, so we'll see a little bit of relief. 10-year Treasury at about 2.14. It was at about 190 about a week ago, so it jumped up. Everybody's scrambling to try to lock in long-term financing, Ralph. They're all calling me all of a sudden in a panic saying, I got to get out of my short-term financing, my construction loan, my bridge loan on Net Lease, and I got to lock in long-term financing with these higher rates. Today I quoted a little jack-in-the-box deal, and I think we'll do like a 7x7 fix for 7, 3 3/4 with like a 25, 30-year AM, so that's good. And we are seeing a lot of developers coming in for takeout loans and others that want to, pull cash out with these higher interest rates while the historical rates are still low. So tell me a little bit again about Envoy, and hopefully we can work with you with 7-Eleven developers, O'Reilly developers, Walgreens on preferred equity and construction. Where are you located, and what are the type of transactions you're structuring, Ralph?
Chris, thank you for having me on Net Lease TV. Envoy is based out of suburban Chicago. We cover the nation. We've done over 107 transactions since our creation in 2012. And what we focus on is both the equity capital as well as a high leverage construction loan program for preferred developers of net lease properties. Most of our clients, I would say 90% of our clients are merchant builders. They might keep a few, but primarily they're selling off about 2/3 to 3/4 of their portfolio. And what we compete against is usually the local bank or a banking institution. What we bring to the table is 100% loan to cost financing against 80% loan to value on investment grade tenants, and 75% loan to value against 100% loan to cost on non-investment grade tenants.
Ralph, let me ask you something real quick before you continue on. I didn't mean to interrupt you.
No problem.
Do you have any of these developers that would want to take your position out with more long-term financing while we're on the subject? Like, or most of these people, their exit strategy is selling to 1031 buyers?
Most of them are selling to 1031 tax-free buyers, or they're selling to REITs. We've seen a lot of REITs. We've had a small property at Advance Auto in Milwaukee, Wisconsin, sold out to a REIT that we all know. It was a $1.9 million transaction. So you're seeing the REITs go down to places where they used to never tread. Before the pandemic, you never saw a REIT go below $5 million for a transaction. Now they normally, there's a lot of REITs that will, and that's the big.
Chris Marabella. This is Chris Marabella. This is Chris with Marabella Commercial Finance.
That will, and that's the big difference out there, and that's why I think is one of the reasons why there's a shortage of 1031 tax-free exchange properties out there, is that REITs have been buying them up even before they hit the market. And so you're seeing a lot more not that many new properties on the market. I mean, there's not that many 15-year brand new properties on the market. And that's both because of the pandemic and the supply chain. A lot of properties usually takes 12 months to develop most of these small properties. 12 months ago was the middle of COVID. And so very few properties got started last year. And so we're sitting here with a shortage of properties and a historical high in 1031 tax-free exchange market or exchange money out there. which has pushed down cap rates, as you know, by 100 basis points in the last year.
Yeah. Why would if some clients come to us, some developers that we meet at ICSC, doing like the O'Reillys and the Chick-fil-A's, the Walgreens, the 7-Elevens, why would they come to us, and why would I arrange with you your type of financing versus a conventional bank, their local conventional bank? What's our advantage there to the developer?
Usually higher proceeds. We can go all the way up to 100% loan to value. So I say proceeds, and then reliability. We can go across the country, and once you get into our program, we can close on a construction loan in 3 weeks once we have all the materials.
3 weeks. Okay,
yeah,
that's really
cool. The first deal is usually 30 to 45 days because you have to get the loan documents done and everything. But we have closed a deal in 18 days. So, and the other thing is, a lot of our developers get checks back at closing because we fund all of the construction dollars back. And so if you're 100% loan to cost, you're getting all your pursuit dollars, all your deposits back on closing. And that allows developers to now take that money and put it into the next deal that needs to be developed or needs pre-development money. So it really is for developers who really need to turn their money over and invest in other properties. I call us an equity extender. You don't have to have investors with our program, so you don't have 10K1s, investor relations. We lend all the money for the project, and you can just turn that money over, sell that property, and move on to the next one, and we borrow from us and continue to do that. So that's the two things: proceeds and reliability and quickness. We have never quoted a deal. We go from a preliminary term sheet to a full-blown term sheet, and that preliminary term sheets are typically 2 to 3 days once we get all the information. And then within 10 days, we can get a full-blown term sheet. And if the due diligence is all clear and everything, we can close on that term sheet. So we don't have a committee process. You don't have to wait until all the appraisals are in or anything like that. We do have an appraisal, but they're not the full-blown bank appraisals. They're usually just based on market comps, and we lend 80% off of that value, and that's the. Term sheet, we fund on that, and we pride ourselves on funding on term sheets that we issue. And as I said, we've done over 107 transactions since 2012, and the only deals that people have walked away from are from the developer side, or the information they gave us was incorrect.
So let me ask you something, Ralph. I'm a developer, okay?
Sure.
And I went to ICSC. I have a piece of property. I haven't closed on it, but I got it tied up under contract for 6 to 12 months. I come to you and I say, hey, I'm negotiating with Jack in the Box. I've submitted an LOI. They've signed it. We're going to go to a lease. My attorney's going to start to haggle on the lease. What are some of the things you're going to ask me? Like, what are some of the qualification questions you're going to ask me? Like, do you have you started to get permits? Right. That kind of stuff, to know if there's a deal there where you can work with me as a developer.
Sure. The first thing is we're going to ask about site, especially in California, site plan approval and your building permits, since those take such a long period of time. We can work with you on the building permits side, but we really need to have that site plan approved before closing. Second of all, that's especially true for fast food or QSR deals. And the next thing we need to know is we really need to before we fund, we have to have your contract, your GMP contract nailed down. And then
what's that?
that is
With your general contractor, you're saying?
With your general contractor, your maximum price.
Okay.
Contract for your construction. And you can have allowances and so forth for various items.
Do you do a land draw? Do you do a land draw? So the guy, he's got it, I got it tied up. I got the land tied up, but I haven't closed on the land. Do I need to own the land, or do you do a land draw? Like I financed a Rite Aid a while back on a construction loan. And that was with, I think it was with US Bank, and we did a land draw. Do you do something similar, or how does that work?
We will do a land draw, but all the site work, the lease has to be signed, the GMP has to be completed and signed. So it's really the same as where you are with a bank. We fund at the same point. We just fund faster and we fund more proceeds.
So I need a signed, I need to have a signed lease with the tenant before I really should come in. If I have an LOI, maybe there's some talking points with me and you, me representing, working with you as a broker. But when I'm talking with developers, I want to make sure that they have pretty much a signed lease with the tenant before, and you also need a cost breakdown, like their costs, land costs.
We need a preliminary budget. Most of the developers we deal with already, they have developed 7-Elevens before, or O'Reilly's and so forth. So they have a pretty good idea of their costs. And once you get the land contract in there, it really comes down to site work. That's the number one thing. And you really don't know that until you get your site plan approved. And then you really need to, in this day and age with construction costs, really need to get to a point where you have your GC tied down. And we've talked to people up to 6 months before we fund it. So we can talk to people, give you a preliminary idea on, it's pretty much if you have $120,000 net triple net rent, and that the market's probably about a 5 cap, you can pretty quickly get an idea of what the dollar amounts that we can lend on that, and and so they have a good idea. So
if I've got 120,000 NOI and the guy's going right now, what do you think? Like a 6 cap? Is that where?
Yeah, I mean, if it's California, it's probably lower than that, but let's choose a 5 cap to make the numbers easy.
So let me figure this real quick. So 120,000 divided by a 6 cap would put me in at 2 million. 2 million is where they would go in, I guess, and then.
Yeah, and then take 80% of that. If it's Jack in the Box, it'd be 80% of that.
A million six, and then what?
That would be our maximum proceeds. So the real question is, when he gets his budget put together, where is he on that number?
Well, I thought. So what I'm trying to figure out is, so I thought you do 100% of the cost of the guy's.
We do up to 80% loan to value.
Okay, so 80% LTV. And then you go 100%. I see.
On cost.
On cost. You go over 100%.
Sometimes we include the developer fee.
Sometimes you include. So the developer fee is not included in the cost. Is that?
Sometimes it is. Sometimes it's not. If sometimes when the numbers are tight, the developer fee is left out, or it's contributed as the equity to the deal.
Hi, this is Chris Marabella with Marabella Commercial Finance. I'm here above beautiful Beverly Hills. If you're currently leasing your mansion property and you're thrown into a 1031 exchange, you should be exploring triple net properties such as Walgreens, CVS, Jack in the Box, 7-Eleven, Dollar General, which are normally called net lease 1031 exchange properties. With a net lease property, the tenant takes care of the insurance, maintenance, taxes, and everything. So you can identify a property pretty much anywhere in the United States as long as it's a true triple net property. If you
or it's contributed as the equity to the deal.
Do you look at a takeout? Like when I did the loan with the Rite Aid, that construction lender looked at a takeout on a loan, I guess in your case, you're looking at a takeout on a cap rate, or do you look at?
Right. We're looking at, if you take what is the debt yield at a 6 cap divided by 0.8, you're talking about a debt yield of what, about 7.2. And so that's kind of what our safety point is. It's kind of like, right. I'd love to own a Jack in the Box for a 7.25 cap rate. So we feel pretty comfortable that the developer can sell it for that. And we focus on properties that have deep record or deep histories of sales comps. We're a little bit more conservative if the tenant doesn't have a history of sales comps behind it. But you look at Jack in the Box or any of the 7-Elevens. I just pulled down Dutch Brothers the other day. There's over 100 comps out there in the last 18 months. So you can get a pretty good idea what the brackets are and cap rates quickly on net lease properties, and that's why.
So let me back you up, Ralph. You mentioned the debt yield. What was that formula again? Explain that clearly so we understand what you're saying.
Sure. I mean, if you take a 6 cap,
okay,
and divide it by 80%, which is our maximum loan to value.
All right.
You should have a debt yield of
7.2. You're saying?
I'm guessing on it, but I'm pretty close.
Hold on, and so that's how you figure it. Okay. And what is a good debt yield? What are you looking for in a debt yield from, I guess, your standpoint, or the developer?
Much about 175 to 200 basis points above where the market is today.
So 0.06 divided by 0.06 divided by 80%. That's eight something. Let me see. 0.075. 0.075. Is that good?
Right. Yeah.
What do you want to see as far as a debt yield? What do you want to see?
Usually about 200 basis points above where we think the market is. So if you think the market is,
yeah,
150 to 200 basis points above the market. So in this case, if you said the market's 6 cap, this is 150 basis points.
What do you prefer, equity or construction, or can you do both?
We can do we do both, and let me differentiate against both of the two programs. Some people have great banking relationships. We have a Pet Suites developer who has a very high loan to cost ratio and very cheap rate with his bank, and so he still needs that last 15%. In this case, and so we just do a flat fixed rate preferred for him, and those are $500,000 checks in this case, pretty much, and we just provide the preferred equity as a senior member of the operating. There's two equity. There's a Class A and a Class B. The Class B is the developer and manager of the usually the developer of the entity developing it. We're the Class A member, and we get our money, we get our preferred return, and then he keeps all the returns above that.
What kind of preferred return are you doing right now?
It depends on the size of the checks, but if it's above $1 million,
that 500,000 you just mentioned.
Yeah, and the 500,000, that's about 21%. But that typically is outstanding for less than a year, and so we're putting in, I can say the last two we put in 500,000. The developer paid us about 75,000, and he made about 10 times that on the deal.
Right, when he went to sell. Okay.
And so it's an affordable option for people who have access to.
What do you do on the split when you sell? Is it
we get a minimum return. Usually it's 125, but that's it. And then he keeps the rest. So we're first in, first out.
50/50, or is that?
No, just fixed. Just fixed. And we do this pretty much with investment grade deals or borrowers we have a long history with. But we just take our fixed return, and the developer keeps the rest.
So explain that to me. How does that work in numbers? If you
put in 500,000, let's say it takes a year, we charge, make it numbers easy, 20% pref. So you owe us $100,000.
Okay.
Okay, the first $100,000 after you pay off the construction loan is first you pay back the $500,000 to Envoy for its preferred stock, and then you pay $100,000 to Envoy for its preferred return, and then you keep the rest.
Okay, interesting. And what do you, most developer, now let me ask you something. What if a guy is doing a ground lease and the tenant is building the building, but he doesn't have money for the ground lease? Have you had any of those kind of?
Yeah, we've done a couple of ground leases where we run those through our debt program, and we just treat it as a one-time draw. So let's just say you have $500,000 land cost. You have $300,000 of site work that you have to give to the tenant after you're done.
Okay.
And the value is, let's just say the value is $1.2 million, so that you have plenty of loan to value there, so we can fund 100% of that $800,000. We just fund all that up front, and then we put the $300,000 into escrow. 6 months later, the tenant's done building it. They ask for their reimbursement. We give them we fund that out of escrow, and then you refinance us or sell the property at that time once they start doing that. We also, one thing I haven't told people, but we do accrue all the interest. So if we do a 12-month loan, we accrue 12 months of interest at an average balance.
So that person for 12 months doesn't have to make any payments.
Correct.
It's just built into the cost of doing the deal.
Right.
That's a great thing. That's great.
Yeah.
But they got to make sure they get the project done in 12 months, right?
Right. Yes.
After 12 months, they're going to start
We
paying.
usually have 2 or 3 extensions, but
Okay.
most of our construction periods are about 6 months. We've had 1 or 2. We had a gym deal that during COVID went past because they couldn't sell it. So we gave them 2 extensions. It wasn't cheap, but they had cash flow to cover it, and we gave them 2. They had 2 extensions. We actually gave them a 3rd extension because we're not in the loan-to-own business. So okay. So they were able finally to sell actually they refinanced that one. They finally found a bank to refinance it.
Ralph, do they have to sign for the loan personally, and do they need to give you tax returns? So it is full recourse deal.
Yeah, they're full recourse deals because of our terms that are like 12 to 15 months. Most of the times, because we need a completion guarantee. The completion guarantee is pretty much, most of your guarantee on these deals. And by the time you're done building it, you're 8 months into it. And I can tell you, most of our developers in the last 6 months that are selling have sold their properties within 60 days of completion.
Really quick, right? The market's
really
hot.
quick.
If you got in at a good cap rate, then it's a good deal, right?
Yeah. So on some of our bigger developers, we've dropped the recourse upon lease commencement, but there's always a little piece of recourse in there just because we want to keep.
Where can a developer stub his toe if he doesn't figure the cost correctly, or he gets too aggressive with the tenant and locks in too low of a cap rate? Where can a guy get in trouble? And where rates rise really quickly on you guys, is that where there can be trouble?
No, we're pretty good on. Up until recently, we fixed our loan terms. Now we're back to a floating rate just because the LIBOR is going to start going up again. But where people really get in trouble, and this is what we focus on with our developers, is how much liquidity they have.
Okay.
Most of the times, we've had some delays, just not getting product in and so forth. So the biggest thing is to make sure the developers and the contractor can get the project done in the amount of time they have. And if they don't have good liquidity, make sure that they have extra contingencies in the budget, because it's much easier to borrow the money up front, as you know, than it is to ask the lender for money later on. So
so if you did the 800, the land 500, the 300 site, that's 800. It's worth about $1.2 million. What kind of liquidity would you want to see? 10 or 20% of the 800?
Yeah.
So like 80 to 160,000 in liquidity?
Yes.
What kind of net worth would you want to see that developer? Would you want to see like 800 to $1.6 million?
Yeah, somewhere in there. One
Like
to two
1 or 2 times
Yeah.
the loan amount? Okay.
I mean, it really,
You do look at the borrowers.
net worth is really comes down to is what is really available versus what it, because there's that, we assume there's value. And this is the reason why I went into net leases. Very few net leases went into bankruptcy or foreclosure during 2008, 2009. As long as you have cash flow, you have hope. As I say, with no cash flow, no hope with lenders. And so, as long as you have cash flow, you can live to see another day. And as I said with our gym deal, there was cash flow there to keep us current and everything. It was painful, but there was cash flow. We want to make sure our developers have the cash to finish the project. The biggest thing is to make sure you finish it on time, so the tenant doesn't have a right to cancel the lease. They're usually drop deads in the leases, so we're really on top of people. We also do our own loan servicing. So if there is a problem, you're calling Envoy. You're not calling a loan processor or a disbursement company down the street. We're involved in all of our loan draws. We talk to our developers directly and make sure that the loan draws are processed quickly.
What are the most significant tenants you think right now? Like Dollar General, is that an area? Dollar General
is still doing well. I think this year you're going to see a lot of QSR guys are really looking for sites. The problem is finding the sites and finding them to make sense.
Jack in the Box, like Jack in the Box.
Raising Cane's, Jack in the Box, Chick-fil-A, Chipotle is going to be rolling out probably 300 to 400 units starting. They're gearing up to do 300 to 400 units a year. So you got quite a few QSR chains that are starting to get back in the market. It's kind of an issue of just getting people back in the office and then getting deals approved and then going to cities which don't have everybody back in the office. So there's an extra 6-month drag out there to get deals done because of just the slow process that COVID has created. And then there's, you got to find the good sites and you got to find the supplies.
Right. Ralph, are developers doing what are called formula deals with the tenants? In other words, where the cap rate is locked in at the the return on cost at the very end?
Yes.
With the rising interest rates, are you seeing any of that? I know in 2009, we started to see more, they called it formula deals, where they in their LOI and the lease, the cap rate or whatever, return on cost wasn't locked in to the very end. So if rates jumped, they went off a certain index, like the 10-year treasury, versus locking in.
I've started to hear people talk about those. Most of them haven't yet. I mean, a lot of deals are falling apart right now because the rent numbers people want to pay and what the developers are coming back and saying, a 7 cap on this number is not going to work. But all the tenants are like, yeah, but cap rates have gone down 100 basis points in the last year. To me, I think cap rates are going to start eking up here probably next year, end of this year, and next year. Really depends on how many people are selling apartment buildings. I think on the 1031 tax-free exchange side, but the cost of capital for REITs are starting to go up. Their stocks are down about 10%. So their cost of capital is starting to increase. So we combine that with increased interest rates, as you know from all the people calling you. There's going to be some resistance on cap rates. I just think there's so much money in the market right now that for the next 6 months, people are going to buy whatever's available. But I think next year it's going to start creeping up. I don't think it's going to be huge increases, but who knows?
Right.
I didn't know there was going to be a war 6 months ago when I started a few of the loans that we've done. So that's.
I heard on CNBC yesterday, they said that the Fed may be a little bit more dovish. They're not going to be as hawkish. That the economy, yeah, it's stronger, but with the instability, political instability, with the rising oil prices, that's going to slow down the Fed a little bit, and you're not going to see the number of rate increases that they thought. They're going to be a little more dovish, which I see. I mean, I think, you know, the economy was really humming along October to right around when I went for Net Lease TV. I went to South Coast Plaza, okay, on Black Friday. And right around then is when Omicron really hit here. And I think that's when things started to slow down. And it's been a little slow. I had one client, we were doing a Walgreens deal, and he got the coronavirus and went into the hospital. So we had to wait till he got out of the ICU to finish the deal. And that really slowed us down. I think that the economy started to slow up right around Black Friday, November 25th, and is now starting to pick up some momentum again. Do you see that from your vantage point?
Yeah, I see people wanting to get back to work. You know, everyone was supposed to go back to work last September and October, and then it stopped. And now people want to get back to work. They're trying to get people back into the office. I think that's going to happen here in the next 60 days. And people, you know, as I said, you know, the municipalities still don't have everybody into the offices, so that's slowing down permitting and so forth. But I saw this morning the market's still pricing in 7 increases, 7.25%. I think that the Fed's going to kind of stick to what they said in the past for credibility purposes, which is 4 increases, and then they're going to wait and see where we're going to be. And, you know, that puts us at 1% short-term rates. I mean, you and I have been in this business long enough to have a, you know, LIBOR at 100 was always thought to be a great thing. So it's amazing how comfortable or used to things that we are. And then all of a sudden people move our cheese and say, wow, rates are really going up. But you know, LIBOR at 1 and 10-year at 225 is still a good market and good debt.
You know, the one thing we're watching, and I think the Federal Reserve, is the 2-year Treasury versus the 10-year Treasury. It really hasn't inverted yet, but that margin is getting skinnier. And if you look at a graph, whenever the 2-year Treasury touches the 10-year Treasury, about a year or two later, we're in a recession. So, you know, the last time, 2008, was the last time we saw these high oil prices. That was right after, you know, Bush was going out, I believe.
Right.
And we saw the federal funds rate, I think it was like 5% or something. You know, so I don't think we're at that point yet, but definitely, you know, the triple P and the stimulus, that was a lot of stimulus, right? Going into the market that we haven't seen since probably, I don't know what, the early 80s, you know, and it started with Trump. Trump did, you know, put a lot of money into the system with a triple P, and the Fed chairman, Powell, was stimulating. So you had
he's buying mortgages.
You had 2 countries going into the economy, and now it's like we're trying to, you know, slow down the party, right? But we have a lot of momentum.
We just closed a Walgreens refi transaction and a Jack in the Box. Both of those transactions were in the mid to high 3s. Call me if you require net lease financing. 760-803-6464. 760-803-6464. Thanks.
A lot of momentum. So not only was it Biden, it was also Trump. They're both, you know, the economy's heated up.
I think we're living through kind of a hangover period right now. I mean, most of the stimulus money is out there. People are now spending it on gasoline instead of other things. And, you know, inflation is going up. But there's still a lot of demand out there. I mean, if you look at the car industry, you know, you go, there's no used cars out there, and I'm looking forward to buying a new car. I just haven't gotten around to it. There's a lot of pent-up demand. You know, there's probably 3 or 4 million cars that people would buy if they were available. So I'm not too worried if, you know, there's a war going on. There's a lot of other stuff. But I think if there is a recession, or it could be a stalled recession, because there's still a lot of demand. I mean, you know, our kids are buying houses. They want to buy condos. My son is closing on his condo in 3 weeks. There's a lot of pent-up housing demand. The problem is prices are too high. But, that's just going to, people are just going to have to wait longer. And, prices are in housing spike up, and then they flatline, and then they spike up. And so we're going to, with the rates going up, we're going to have, probably a period where home prices are going to flatten out. And so I think this first part of 22 is going to be kind of finding our way. And the second part of 22, I think once people get back in the office and start doing business, things will pick up again. Saying that, we'll see how high the interest rates go.
So Ralph, here where I live near Rancho Santa Fe and La Costa in Carlsbad, prices have pretty much doubled. The housing prices here were at about $1.4 million. Now they're at about $2.4 million. So within a 2-year period, they've doubled. And that's, because there's no supply.
Right.
And there's no houses. So
Correct.
when one comes up, it sells in days. And
right.
San Diego, I think, is going to be hot. If this war thing continues on and we go into this Cold War, I think defense is going to be really big. San Diego normally benefits from that. We've got Top Gun, Miramar. We've got, all the shipbuilding, submarines, drones. So San Diego is going to boom in the next 5 years. The only problem, there's no land. So prices are going to keep going up. I think
what you're going to see is, I think that's the case, but you're going to have, the manufacturing of those drones are going to happen in Phoenix. The engineers and those kind of guys are going to be in San Diego. It's kind of, I'm in the Midwest, and the brain trust of the auto industry is in Detroit, but everything is pretty much built or made. The parts are made all the way down I-65, all the way to Mobile. So you're going to have that kind of effect in California, where a lot of brain power is going to stay in California, but the manufacturing. But even there, you can't manufacture a boat in Phoenix. So you have to be in San Diego for those things. And longshoremen are doing great right now. They're making $225 a year with base pay, let alone overtime. So there's a lot of income drivers in Southern California as well.
Ralph, let me ask you this: when you're doing deals, we encounter this quite often. Either leaky underground storage tanks at the subject or across the street, dry cleaners. How are you dealing with environmental when you're looking at projects? Is that a big deal? Do you have to have the developer remediate a lot before they get the projects going? How's your feeling on environmental phase 1, phase 2s, and that kind of thing?
Most of the developers that we've dealt with, most of the sites have been remediated. First, we get the phase 1. If it's a phase 2 site, usually most of the smaller developers blow out of those deals, and the more sophisticated developers take those deals over that have the wherewithal to do the phase 2 and do the remediation. And usually we don't step in until there's a phase 2 and a do not disturb NFR letter from the state or so forth. And in California, those are deals that have been out there for 2 to 3 years, and then they're finally ready to move forward. And then those are also the deals in California where you actually have landowners that will give the developer as much time as he needs to get the deal done because of just all the timing and the state regulations and so forth. So we've done a few with that, but usually the developers have had those buttoned up before we do that, and we usually take those reports and have our environmental consultants to review them.
So let me just kind of conclude, because we're getting there. Yeah. We don't want to keep dragging on too long. If you're a developer here in my area, in San Diego, Orange County, Los Angeles, Beverly Hills, Inland Empire, which is just blowing up like crazy with houses and retail, the Hemet area, the Riverside area, Ontario, Upland. If you're in that area and you have a project that you would like, I would like to represent you to go into Ralph. What are the minimum things and they can meet me. I have an office downtown San Diego. I have an office La Jolla, Carlsbad. Beverly Hills, Los Angeles, and Corona. So if you're a developer and you want to build a relationship with me and Ralph to do your construction financing, your preferred equity, we'll meet up. What are the minimum things they should bring to the meeting, Ralph, when I meet them to start to work on construction and preferred equity with you?
Sure. It's not that many things. So first thing is the letter of intent or draft lease. We'd love to have the finished lease, but just an idea where the rents are locked down. That's the first thing, is making sure you know where your rents are, or as you say, a formula of how to figure out the rents, because a lot of times they're open book type of deals, but the economic terms have been locked in. And then a pro forma with a cost budget, and it doesn't have to be a perfect cost budget, but it needs to be firm enough that we understand where they're at, cost versus value. We'll handle the comps and figuring out what we think the preliminary value is. And then, just some maps, site plan, the typical things that you have in a development package, and then just some information about the tenant and the area. So it's not much different than not much different than what you would give a bank. So
if you're out there and you want to meet up with me, what we'll do is do a go-to meeting with Ralph, and we'll start to get that together. We'll set up a Google Drive. You can upload all the documents to our Google Drive, and then we'll strategize with Ralph to build a relationship to do some deals with you. So call me, Chris Marabella Commercial Finance, then I'll coordinate with Ralph. 760-803-6464. If you want, you can go on our website at the top and set up a meeting with me at one of these offices through our Calendly, and then we'll bring Ralph into the fold. Thanks again, Ralph, for being on Net Lease TV. I appreciate it. I hope we can get you some preferred equity construction financing here in Southern California on Net Lease. And thank you again for being on Net Lease TV, Ralph.
Thank you, Chris. It was a pleasure.
Thanks so much. Thanks, Ralph.